Hi, welcome to Digging to China. I'm Dang Xiang. Today, let's delve further into the topic of China's special government bonds and ultra long-term government bonds. I'll also share my perspective on the potential social conditions that China might experience in the near future. In May of this year, China officially announced the plans to issue ultra long-term special government bonds, attracting considerable attention. This is because such a financing method has not been mainstream in the past. While the Chinese government has issued bonds before, they were not in this special format. Additionally, Chinese authorities have stated that the frequency and the scale of issuing such special bonds will increase in the future, suggesting that this method could become a mainstream financing strategy. Many people might believe that the issuance of special government bonds by the Chinese Communist Party doesn't affect them. However, it is closely tied to everyone, especially those residing in China. This signifies a fundamental shift in how the Chinese government mobilizes funds, marking a watershed moment. The economic structure before and after this change will be entirely different. Not understanding this can lead to significant misjudgments about the economy, which would be very detrimental. China has issued special government bonds before, and it won't be the last time. However, the key distinction lies in the fundamental differences between the special government bonds issued now and those in the past. In years like 1998, 2007, and 2020, China issued special government bonds mainly to address issues such as natural disasters, foreign exchange management, and bolstering the capital of state-owned banks. However, the special government bonds issued in 2024 serve different objectives altogether. Here arises a question: what reasons drive Xi Jinping to heavily utilize special government bonds for fundraising? In essence, the logic behind issuing special government bonds can be summarized into three main points. Firstly, it's clearly intended to combat deflation. Secondly, it seeks to invigorate capital through this method. Thirdly, by using special government bonds, it circumvents complex national financial procedures, aligning with Xi Jinping's straightforward approach. Therefore, the operation of special government bonds is guided by these underlying rationales. Let's start with the first aspect: combating deflation. Economist Milton Friedman once famously stated that inflation is always a monetary phenomenon. While this assertion holds merit, you may wonder why a country like China, which engages in extensive money printing, experiences deflation. In reality, China's domestic currency issuance is substantial, with the broad money supply to GDP ratio exceeding 214%, compared to less than 75% in the United States. Despite China's significantly larger money supply, it experiences deflation, whereas the United States, with a relatively smaller money supply, faces inflation. What's the underlying reason for this? In reality, the relationship between inflation and the money supply isn't merely about the quantity, but rather about the flow of momentum of money. Therefore, Friedman's statement should be understood as inflation being a phenomenon of currency circulation. This means that even with a large total money supply, if the currency isn't actively circulating within the economy, lacking velocity, it won't cause inflation. In simpler terms, stagnant money, like a stagnant water, won't lead to inflation. Only currency actively circulating throughout the economy, like blood in the body, can cause inflation. Looking at it from this angle, despite China's extensive currency issuance, this currency lacks vitality and fails to circulate effectively throughout the economy. Consequently, the entire economic system shows signs of insufficient blood supply, weakness, and even anemia, resulting in economic deflation. Let's examine the historical relationship between China's M1 and M2. Since 2008, China has increased its currency printing. However, for the most part, the growth rate of M1 has been smaller than that of M2, indicating that the growth rate of active money is lower than that of inactive money. Essentially, there's been an abundance of inactive money compared to active money. Reflecting on the period since 2008, we'll notice that despite this imbalance, China didn't experience deflation but instead maintained a mild inflation. Why did China shift from inflation to deflation after the global financial crisis? In reality, post-2008 inflation in China was superficial. The currency's essence leaned towards deflation. When the 2008 global financial crisis hit, China's economy faced recession. As an export-oriented manufacturing economy, a decline in overseas orders would have a widespread impact. However, China didn't immediately enter deflation after the crisis. This was because China employed large-scale infrastructure projects like railways, highways, and real estate to stimulate currency circulation. With increased economic activity, more money was required, activating currency circulation and resulting in mild inflation. This process is often referred to as input-driven inflation. Inflation stemming from the real estate and infrastructure sectors seeps into the broader economy, which was previously experiencing deflation. As land and the rental costs increase, prices are elevated, causing a shift from deflation to inflation. This isn't a healthy type of inflation, it's rather a forced one. It could be understood as the real estate bubble delaying deflation in China. Additionally, since speculation in real estate was widespread across the country at that time, there was a high demand for loans. People were unwilling to keep their money in banks and instead preferred to use their savings for down payments than borrow from banks. This stimulated the loan market, resulting in substantial profits for the financial industry. Let's examine the major cycle of China's real estate sector. Following the subprime mortgage crisis, there was a substantial surge in the area of newly initiated housing construction in China, surpassing 1 billion square meters. This trend continued with the area of new construction breaking the 2 billion square meter threshold after 2018. However, there was subsequently a steady decline, with the area dropping below 1 billion square meters again by 2023, returning to pre-2009 levels. This cycle reflects China's economy, which has experienced a prosperous phase alongside its real estate sector, now transitioning towards recession and deflation. Put differently, the current deflationary scenario is intertwined with the downturn in the real estate sector. As the property market declines, funds cease to pour into real estate, failing to drive activity in related industries. With the absence of new economic ventures, investments dwindle, and the currency remains stagnant, leading to the onset of deflation. Since 2020, China's overall social financing has seen a continuous decline. Monthly year-on-year growth in social financing has dropped from around 14% to 8% by April of this year. Both personal loans and corporate financing have been declining since May 2023. Before the pandemic, personal loans were growing at nearly 20% year-on-year, but have now fallen to under 5%. Simultaneously, individuals and businesses have lost confidence in the real estate and the stock markets, preferring to keep their money in banks for savings, wealth management, rather than taking out loans due to fear of high-risk investments. Statistica shows that from January to April 2020, China's real economy received a total of 12.09 trillion yuan in funds, with over 55% held in the form of deposits. Regarding wealth management products, their outstanding balance in China has been steadily increasing over the past 2 years, reaching a historical high. Since March 2023, when it stood at 24 trillion yuan, it has risen to the current 29 trillion yuan. Chinese enterprises are the primary purchaser of these products. The data illustrates a situation where bank savings and wealth management have surged, while demand for loans and investments has declined. Both individuals and businesses are cautious about taking risks or investing. Consequently, there is no input-driven inflation. The deposits and wealth management funds held in banks remain idle in accounts, unable to stimulate upstream and downstream industries, leading to deflation. To put it differently, past inflation was essentially a facade, particularly during the era of the so-called real estate bubble. Input-driven inflation was akin to cosmetics. Applying it made things look better superficially, but it didn't alter the underlying reality. Now, with the collapse of the entire real estate sector, it's as though this cosmetic layer has been removed, revealing people's true faces. And this true face is an ugly one. It's the face of deflation. So, if inflation is followed by deflation, what comes after deflation? Well, after deflation comes the era of plunder. In the past, China could still rely on the real estate and the stock markets to deceive and manipulate to some extent. But now, there's no more deception. It's direct and blatant plunder. This indicates that the future will be even tougher for the Chinese people. Let's delve into what these difficult times entail. As mentioned earlier, in the past, money in China predominantly flowed into the real estate market and the loans, driving the overall economy. However, now, funds are directed towards savings, deposits, and wealth management, which have limited the potential to stimulate economic growth. This shift in financial behavior signals a fundamental departure from the speculative fervor seen over a decade ago, and it's unlikely to be easily reversed. Other than the impact of the real estate market collapse, another significant factor contributing to this shift is China's aging population. According to the lifestyle theory of investment, people tend to become more risk-averse as they age. This tendency is especially pronounced after the age of 60, when investment capacity diminishes significantly. Risky ventures such as stock trading and real estate speculation becomes less attractive, leading older individuals to favor safer options like fixed deposits and fixed income securities. Given China's aging population, with the proportion of individuals over 60 steadily rising, this trend is particularly relevant both now and in the future. Based on projections by Statista, China's population aged 60 and above is forecast to exceed 26% by 2030, reach 38% by 2050, and stabilize around 48% after 2080. With aging correlating to risk aversion, future China will be a society worried and fearful of risks. Consequently, societal behavior will lean towards saving and depositing. From this viewpoint, China's challenges extend beyond the real estate downturn. In an aging society, the proportion of taxpayers will drastically decline, while the elderly relying on retirement pensions will sharply rise. This demographic shift will lead to heavier societal burdens and reduced economic productivity. Moreover, an aging society lacks demand for loans and investment. Elderly individuals are unlikely to engage in long-term loans and are also risk-averse, dampening investment enthusiasm. With decreased demand for loans and investments, the overall society will experience lower interest rates, including reduced yields on government bonds. In the financial domain, there will be an excess of supply compared to demand, as an aging society tends to prioritize a more tranquil lifestyle over financial pursuits. This situation presents a tangible challenge. Following the real estate market collapse, China may find its stock market financing mechanisms less effective, as fewer individuals are willing to take on risks and prefer a retired lifestyle without much worldly engagement. In such circumstances, unable to rely on real estate or stock market financing, China will have to turn to the bond market and government debt issuance for funding. Therefore, it's expected that the current rollout of special government bonds will see further widespread issuance and expansion in the future. From the Chinese government standpoint, if the people prefer saving, the government will simply bypass them and directly take funds from the banks for national development. In practice, the main buyers of government bonds, including special bonds, are banks and institutions. Individual savers aiming to avoid financial risks deposit their money in banks as savings wealth management products. The government then issues special bonds, which are bought by the banks using the savers' deposits. Ultimately, the money makes its way from the people through the banks back to the government to finance major projects under the guise of national rejuvenation. Once the money goes through the government, it inevitably gets entangled with corruption and embezzlement. Consequently, the projects funded by these special government bonds are destined to yield very low returns or even significant losses. The real beneficiaries are the corrupt officials who profit from these construction contracts. In the end, the money flows from the government's hands into the pockets of these corrupt officials. Chinese citizens often delude themselves into thinking that simply saving money rather than investing will protect them from financial exploitation. However, the Chinese government has numerous ways to take money from the people, and the special government bonds are just one of these methods. Once this practice begins, it can easily become an addictive practice for the government. In extreme future scenarios, special government bonds could be turned into taxes using even more direct and forceful methods of extraction. As I mentioned before in my earlier programs, during the final years of Chinese dynasties, when a regime change was imminent, the government would find various ways to extract money from the populace. In ancient times, this was done through harsh taxes and levies. In more recent history, the government could use special government bonds, patriotic bonds, or war bonds as a pretext for forced contributions. If you refuse to buy these patriotic bonds, you might be labeled a traitor, subject to public trials, and face public condemnation. Let's see if you still refuse to buy them then. In the end, whether you want to buy these bonds or not, you will be forced to do so. Many Chinese people are still deluding themselves, thinking that they holding a Chinese passport, living in China, and keeping their money in Chinese banks, they can avoid being exploited. This is pure fantasy and self-deception. Even if you don't invest, the government can still use bonds to take your money. And if that doesn't work, they have other methods such as compulsory levies or outright confiscation. Ultimately, there is no escaping this inevitable exploitation. Therefore, under the rule of Emperor Xi Jinping, all dissent is suppressed and the Chinese populace is systematically exploited. As long as the Chinese Communist Party remains in power, the fate of Chinese people being exploited is inevitable. Thank you for watching. Please like, leave a comment, and subscribe to my channel. Just click the subscribe button right here. I'll see you again shortly. Until then, be well.